we actually viewed the balance of risks for yields coming into the recent couple of weeks as more balanced for two key reasons. The first was that you've already seen a very sharp tightening in financial conditions year to date in response to the hawkish policy outlook. And then secondly, we do think that the macro data set is evolving in a way that is less conducive to further sharp rises in bond yields. And so growth is moderating, particularly in the manufacturing sector. And then on the inflation front, you are starting to see tentative signs of a stabilization when you look at sequential month-over-month inflation increases. And also, if you were to look at the trimmed mean measures of inflation, so these are measures that omit any outsized price moves in either directions, those are also starting to moderate, indicating that we're not seeing a further broadening out of inflation pressures from here. That being said, inflation is still above target in all G10 economies except for Japan. And so central banks need to actually deliver on that hiking path that they've indicated in order to help bring it back down towards target.
I don't know if you heard just before you joined us, you were listening to some sound from Jerome Powell. Yesterday, he was speaking on a podcast and he admitted that the Fed maybe could have raised rates sooner, that perhaps had they known then what they know now, it would have made sense to begin hiking rates a little bit earlier. What do you think of those comments? Does that change how you're thinking about the Fed's approach now?
Well, he also said that hindsight is a very beneficial thing. And to his point, he also said he's not sure that would have made much difference. I think coming into this year, two unforeseen circumstances unfolded. One was Omicron spread in China, which has elongated supply disruptions. And then we had the war break out in Ukraine, which again has further elongated the impulse to inflation from durable goods that are supply constrained. And those are two things that investors nor the policymakers could have anticipated. But the important thing is that Fed Chair Jay Powell has iterated that the central bank is determined to move to a neutral policy setting now, given inflation has broadened out to other components of the economy. You are seeing services prices rise. You do have very solid wage growth, although surveys indicate that will moderate going forward. And of course, inflation expectations in the short run are high, and that's why it is appropriate for central banks to act now. To just give you one data point, in the UK, more households search for inflation than Taylor Swift on Google, which is indicative of inflation really being top of mind for everybody in the economy and not just investors and financial markets. That data point isn't going to enter the Bank of England's monetary policy report anytime soon, but it does demonstrate that policymakers globally are very alert to the impact for every household in the economy. And so they are committed to the messaging. And so Jay Powell, at the beginning of the press conference last month, very clear about directing his message towards households. And so there's a clear desire to move to a neutral policy setting.